Hi guys, welcome to Passionate Minds. Through this video, we will be summarizing LKAS2 accounting for inventory. First, let's look at what is inventory. Inventories are assets that are held for sale in the ordinary course of business, which means that if you occasionally sell a piece of your non-current asset, such as motor vehicle, it will not qualify as inventory because occasional sales are not in the ordinary course of business. Sales of finished goods are example for such sale. Next, in the process of production for such sale, for example, work in progress. And finally, in the form of materials or supplies to be consumed in the production process or in the rendering of services, for example, raw materials used in production. How do we measure inventories? The measurement rule is that inventories will be carried at the lower of cost or net realizable value. Simply, we compare both cost and net realizable value of inventories and choose the lowest one. And the first one is cost of inventories. Cost of inventories comprises three vital parts. The first one is cost of purchase, which includes the purchase price of inventories, import duties, non-refundable taxes and etc., from which we deduct trade discounts, rebates and subsidies. Secondly, cost of conversion. These are costs that are directly attributable to the units of production, for instance, and direct expenses. In addition to that, it comprises production overhead as well. Finally, other costs. Other expenses incurred in bringing the inventory to its present condition and location is also included. Now let's focus on the costs that do not qualify as cost of inventories. Administrative overheads, which do not contribute in bringing the inventories to its present condition and location, will not be included. Selling cost, storage cost and etc. Next, what are the two cost formulas prescribed by LKAS2? First and foremost is first in first out. Inventories are purchased at various price in various times. So first in first out method tells us that inventories that we purchase initially at a given price must be sold initially and the cost must be recognized as the cost we paid initially during the purchase of inventories. Next one is weighted average cost method. Simply, this method tells us that the weighted average cost of inventories must be recognized as the cost during a sale. Let's have a look at the second phase of measurement of inventories, which is net realizable value. It is the estimated selling price less estimated selling cost and estimated cost of completion. Now let's focus on the question given below. As of 31st December 2019, cost of finished goods is 10,000. If the NRV of those inventory is 8,000, what is the journal entry? So here they are asking the double entry for inventories to be recognized in the financial statements. According to the measurement rule, the lower of cost or NRV must be recognized at the value of inventory. So here the NRV is lower than the cost, which is 8,000. So the entry will be as inventory account debit 8,000. Since there is a loss of 2,000, inventory loss account debit 2,000, income statement credit 10,000. What are the methods of deciding the net realizable value of inventories? The first one is item by item basis. Item by item basis prescribes that in an organization, each and every inventory must be considered unique and the measurement rule applies for each and every one of them. But however, according to the group method, here the measurement rule applies not to each and every inventory but as a whole. Now let's have a look at the circumstances where we recognize inventories as expenses. When inventories are sold, the carrying amount of those inventories will be recognized as expense in which the related revenue is recognized. Secondly, the amount of any written down of inventories to its NRV and all losses of inventories should be recognized as expenses in the period it occurs. Finally, the disclosures we need to make with regard to inventories. First, the accounting policy we adopted and the cost formula we used, whether it is FIFO or weighted average. Next, the total carrying amount of those inventories, the amount of inventories carried at net realizable value, the amount of inventories recognized as that expense during the period, and the details of any circumstances that have led to the write-down of inventories to their NRV. That's all of it. Thanks a lot guys for watching this video. If you need any further clarification on this topic, contact us through any mode showed on the screen.